What psychological biases influence international market decisions? Imagine trying to decide whether to expand your family's health insurance services into a new country. It's a big step, and your mind can play tricks on you without even realizing it. When businesses or families look at international markets, several mental shortcuts or biases can influence their choices. These biases can make some decisions seem smarter than they really are or hide potential risks. One common bias is overconfidence. People often believe they know more about a foreign market than they actually do. They might think they understand customer needs or regulations perfectly, but in reality, they could be underestimating challenges. This can lead to overcommitting resources or rushing into markets without enough research. Another bias is the sunk cost fallacy. This happens when a company keeps investing in a market because they've already spent a lot of money or time there. Instead of honestly assessing if it's worth continuing, they hold on because they don't want to admit failure. This can cause businesses to stick with poor strategies longer than they should, risking more money and effort. Anchoring bias is also common. It's when decisions are heavily influenced by initial information. For example, if a company's first research in a new country shows high potential, they might ignore later signs that suggest otherwise. They're relying too much on that first impression, which can lead to mistakes. Confirmation bias is when decision-makers look for information that supports what they already believe. If they think a certain market is good for insurance services, they might ignore signs that it's not. This bias prevents them from seeing problems or adapting their plans. Representativeness bias makes people assume that a foreign market is similar to another they know well. They might think a Latin American country will behave like a neighboring one, but each market has its own rules, culture, and customer habits. Relying on this false similarity can lead to poor decisions. Availability bias is when recent or vivid information influences choices more than facts. If a recent news story about political instability in a country is fresh in their minds, decision-makers might see that market as too risky, even if the overall situation is stable. These biases can cause companies to misjudge costs, risks, and opportunities in international markets. They might make investments that don't fit the local environment or miss better options. To avoid this, businesses can set up decision-making processes that include independent reviews and challenge assumptions. Creating a culture that questions initial beliefs helps prevent mistakes. For Latino families and entrepreneurs thinking about expanding insurance services abroad, understanding these biases is key. Recognizing these mental shortcuts can help avoid costly errors. It ensures that family health insurance, life insurance, car insurance, or homeowners insurance are tailored correctly for each market. Taking the time to analyze carefully and consider cultural differences helps build trust and long-term growth in new communities.